Christof, just your view on that in terms of the weakness we've seen in the last few weeks in the oil markets, and I mean, has now the market had its reaction, if you like, or could we see more weakness, or has it completely absorbed the revised forecast for demand?
Well, you see, I should be very pleased because for weeks for a long time we had this discussion with me saying oil markets are more likely to come down than up, and China is more likely to be weak than strong, especially in this Sunday session, always a theme. But I think beyond that, there's something really important to be learned here in terms of the analytics of the way these forecasts were made. For months now, we have heard, especially the bulls on oil markets, treating the oil market essentially as an appendix to other people's economic forecast. So the story, the narrative we all lived with was demand is going to be strong, demand is going to be weak, depending on US recovery, depending on China recovery. That was the story. And then the oil market and the oil price will follow. And what people have not understood is that there are really two important developments which are independent, which are driven by oil markets and not by the global economy, and which have to do with price. And on the demand side, I think it's pretty obvious now when the actual numbers come in. These months and years of relatively historical perspective, high oil prices have taken their toll. So the idea that you take a certain oil demand as a fixed relationship to economic growth, and then if economic growth goes up and down, oil demand goes up and down with it without any change, is plain wrong. Because if you have a period of long, sustained high oil prices, then that causes demand destruction, and the same economic activity can be satisfied and will be satisfied with less oil demand. And that's what we are seeing now. So on the demand side, there's a suffering, an impact of the high prices, very simple. And on the supply side, it's even more interesting, because remember, the other argument for oil prices supposedly going up and staying high, the Goldman Sachs of this world repeat ad nauseum, was always that, and there was a true argument, that the safety buffers in the system were extremely small, meaning there was very little spare capacity, and there was inventories potentially under pressure, so that any kind of disruption would have resulted in high price spikes. And that causes people to hold oil for inventories for safety reasons, precautionary reasons. Now, with these OPEC cuts, which we have seen the second announcement now, of course, the safety margins in the system, the safety buffers, become larger and not smaller. And so the more of these cuts we are seeing, the less this argument that supply is so tight that one has to be careful of price spikes due to any kind of disruption loses its force. And so as a result, what we are seeing is two forces: demand destruction from high prices and excess supply becoming more abundant, more visible in the system, joining forces. And this means ultimately fundamentals of the oil markets reasserting themselves over this sort of slightly helpless discussion that the oil markets will do whatever the economy will do, which is true to some extent, but only to some extent. And so what we are seeing really on an analytical level is something important. This is oil market fundamentals, as Michael said, reasserting themselves in the long term. This is what matters. All this talk about short sellers, long sellers, speculators, they are fulfilling a beneficial role because they smoothen prices. The more they leave the market, as we see now, the more rocky the adjustment becomes. But at the end of the day, they don't determine where the train is going. They just try to jump on the train like everybody else. It's oil market fundamentals reasserting themselves. And they probably, point more towards, who knows, 60, 70, than towards 90 or 100.
Let's talk a little bit about, well, part of the Chinese economy recovery is, of course, to do with exports to the US, the consumer goods, etc. Give us the sentiment at the moment in America on that. I mean, in the light of Fed decisions going forward, we just saw their recent rate hike as expected, and this whole debt ceiling debate that's coming up to a conclusion in a couple of weeks. How much is that weighing on confidence, sentiment for US economic growth, etc.?
It's weighing on sentiment, but sentiment is volatile. First, let me say two things on China. The problem there is not, this lack of demand for oil from China is not jet fuel demand. What is transport fuel? Maybe 50%, 60% of that jet demand, maybe another 10% of that in China. And the problem is that the recovery in China was never to be like this big explosion as we had seen in the US before, because there have not been these monetary transfers during the lockdown period. It's a very simple story. In the US and to some extent in Europe, consumers' pockets were bursting, filled with transfers when they were released from the lockdown. And of course, people spent it also on travel. In China, people may have saved a little bit, but not to that extent. And so the lockdown period just integrates itself into the trend growth decline, which we're seeing in China, which has not stopped. And that's what we see in the diesel numbers. And that's why they are really, as Mike says, are significant. In the US, I think we are still, US economists, one of them called it an extremely opaque economy, very hard to read. And I think it's true. My take, for what it's worth, would still be that we are maybe technically bordering a recession, which just means two quarters of no growth or low negative growth, but it would still be on a very high level. We just have seen unemployment data coming in. It is a full employed economy. It's humming at most cylinders. Some of these export disruptions are painful for Europe and China, but not as much for the US, because remember, they gave themselves this huge program of subsidized replacement of chips, of green energy, of all kinds of things, which tends to even attract inward investment from places like Europe. And so the trade disruptions have not hit the US badly as they would hit China and Europe. And the consumer spending still goes strong. The domestic market large enough for driving and other oil demand components to play an independent role. So I don't see the really dark clouds there. The risks come from the financial sector. The risks come from this system, which they have of a large number of small banks, which are vulnerable under circumstances like these. And a deposit insurance system, a federal agency where everybody can shift the blame to, and which at some point will become overburdened. In Europe, banks are in better shape, and we don't have a federal agency like that, which would act as a lender of last resort, and therefore the pressure is less. And in China, they have nothing of that sort, of course. So the risks comes from financial and therefore market volatility that probably we should expect more of. And then waves of optimism and pessimism adjusting to the data as always. But the data itself themselves are not indicating a recession in the sense of a severe event. I said it before, if you have a recession with 3 or 4% unemployment, I take that recession any day, because it's the term denotes something which is not translating in something bad in real life, and people look out of the window.
Okay, Christof, given the balanced sort of picture that we have now on fundamentals, by all accounts, no worries of tightness, why wouldn't OPEC just to sort of kind of push that sentiment of a bit more bullish sentiment, if you like, going forward on prices? Why wouldn't they not announce a cut in June?
Well, they may, if anybody's ooching at the moment, it's them. But let's get the background a bit straight, and it's actually much more straightforward. Russia has announced months ago this 500,000 cut as a crude oil cut. That has not materialized yet. So if I would be the rest of OPEC Plus, I would be wondering what's going on there. We've been a little bit upset perhaps. And secondly, Russia has not enough storage capacity to really deal with this massive shift when the embargo of products kicked in. Russia is a huge exporter of diesel, as we all know. And as Mike describes, there's a lot of floating storage now because the redirection of products turned out to be much more difficult. But the lack of storage capacity and the problem that the refining margins are coming down everywhere in the world means that potentially there's a lesser demand for crude oil from inside Russia for refining purposes. System gets clogged up, and that explains why the crude oil exports have not been cut at this point. Third one in this development, Novak last week, the Russian energy minister, went public and says, we will implement this cut. And this seems to be the sort of silent under the surface switch from a cut, as it was originally thought, of crude oil products exports into product exports. That we will see almost automatically because they don't have the capacity to really get rid of all these products quickly enough. And then they will sort out over time what the mix between crude oil products will be of that cut. But basically, what happens with these falling prices from an OPEC perspective must also be that Russia is hurting very much. And in that point of the equation, the normal discussion has to pause for a moment, and we have to think about other factors such as the war. Nobody knows, and I'm not going to speculate what this Ukrainian counteroffensive will bring with it. But I certainly would not exclude, if Russia gets into trouble militarily, that they would use the oil option in order to wreak more havoc into Western economies, to threaten with a recession to get people on the streets demonstrating against the costs of the supporting Ukraine and so on and so on. This also a scenario which has been with us for a year. They will use the oil weapon if they have to. And the more the oil price comes down and the more OPEC plus sort of maneuvers on a reactive mood rather than being strategically, as seems to be the case with this last cut, the more difficult it will be for them to resist the temptation of Russia, at least verbally throwing around its weight as an oil producer. And that is an unknown. And I would think that this will keep oil prices on edge and preventing prices from going down in a straight line into the 70s or something. And they may, for that reason, short-term tick up again. So we should not think we have solved the puzzle now because oil demand is weakening and supplies are plentiful, and therefore oil markets will settle into a new range of prices around 70 or something. We have to be looking at this Ukrainian war, because it is the situation is coming to a head there, and Russia has still control over a substantial amount of exports.
Well, I mean, that would be good for OPEC. The rest of OPEC, the Gulf countries, would be happy if there's a bit of upward momentum there because of Russia not,
it makes the puzzle harder to solve. Yes.
Yeah. Christof, sorry, just sticking with you, because I don't know if you addressed part of my longer question earlier, which was to do with this debt ceiling in the US. I did want to get your thoughts on it. You're not going to predict which way the vote goes, obviously, in 2 weeks' time, but how important is that vote to equity markets, what we're seeing in Fed policy, and any ripple effect, obviously, on that? From that,
this is extremely important, and this is something. It's very, very hard to understand how a sophisticated country like the US or world economy can have this kind of situation. The last time this happened in that narrow situation was 2011.
Yeah.
And it led to a downgrade of the US debt. It almost led to, if the US financial system collapses because the government can't pay its bills, it's a very hypothetical if, but if that happens, then the world economic system based on the dollar and on this will collapse with it. And so the stakes are enormous, and still you have a situation in which in the House of the senators from the House of Representatives, a tiny majority could derail this. Yellen, the US Treasury Secretary, the finance minister, basically has warned for months now that in June, the government's ability to pay its bills will cease if there's no agreement on the debt ceiling. The Republicans have put a bill forward to the House for the Senate to sign, for the Democrats and ultimately the president to sign off, which says, yes, we agree the debt ceiling has to be widened, but only if the following cuts are implemented. And there comes a list of cuts which are completely unpalatable to Democrats. So this is dead on arrival, will never be signed. And now there's a stalemate, and individual senators from districts where public sentiment is such as to say, what do we care? Hardcore right-wing people who would gleefully see the system in Washington collapse, have the possibility and do support individual senators who have the capacity to block the system. If we are lucky, if the world is lucky, these senators find a very high price one way or another, which they can extract, and with this pound of flesh, they will give their agreement to lifting the debt ceiling. But if the world is unlucky and the system really comes to a stalemate, then there will be huge financial instability. I still fail to believe that they could let the system collapse because of something like this. But the administrative, the organizational setup is such that it's hard to see a way out, except for some political compromise.